Welcome to the deep dive. Today we're going to tackle something that's probably relevant for a lot of you homeowners: refinancing your mortgage, specifically using a VA loan.
That's right.
We've got the key guidelines right here, and, well, our mission is basically to break it all down, so you walk away feeling clear about your options without getting totally bogged down in the jargon.
Exactly. And we're focusing on the three main ways the VA helps you refinance, according to these guidelines. First, there's the interest rate reduction refinancing loan, the IRRL. Think of it as like a streamlined option.
IRRL. Oh.
Okay. Then there's cash-out refinancing loans. Those come in two flavors, Type I and Type II, offering a bit more flexibility.
Right.
And finally, we'll briefly touch on some other more specific situations like refinancing construction loans.
Okay, great. Let's unpack this. Starting with that first one, the IRRL. For someone just tuning in, what's the kind of the core idea? What's the big win?
Well, the big win with an IRRL really is its simplicity. It's specifically designed to refinance a VA loan you already have. Usually the goal is to get a lower interest rate and, a lower monthly principal and interest payment. And what makes it really appealing is that you often get to skip the usual hassle.
Hassle level.
Like a new appraisal, maybe no credit check, less paperwork generally. Lenders can often even approve these automatically.
That sounds pretty good. A breath of fresh air. But you said often. So where might that streamlined process hit a snag, especially with rates and payments?
Right, good question. So the key is usually the interest rate. It generally has to be lower than your current rate, unless the exception is if your current VA loan is an adjustable rate mortgage, an ARM.
Oh.
And the goal is also usually a lower principal and interest payment. But yeah, there are a few exceptions where your payment could actually go up.
Go up? How?
Well, if you're refinancing an ARM, your due rate might end up being higher later on. Or if you choose a shorter loan term, say going from 30 years down to 15.
Right, pay it off faster.
Exactly. Or the third one, if you're rolling in costs for energy efficient home improvements. In those cases, yeah, the payment might increase.
So even aiming for lower payments, it's not a guarantee. Okay, this is where it gets interesting. What if that new monthly payment jumps up by quite a bit?
Yeah, that's a really critical point. If your total monthly payment, that's principal, interest, taxes, and insurance, or PITI, this goes up by 20% or more.
20%, wow.
Yeah. Then the lender must do a full underwriting process. They can't just streamline it. They have to check your income, your debts, make absolutely sure you can handle that bigger payment. They need to certify you still qualify.
Okay, so that 20% is a major trigger. It kind of negates some of that streamlined benefit, doesn't it?
It really does. It's a safeguard, The VA wants to make sure people aren't getting in over their heads.
Makes sense. Now, what about transparency, making sure everyone understands exactly what they're signing? Are there specific disclosures?
Oh, absolutely. You, the veteran, you have to sign a statement. It clearly shows how the refinance changes your rate and your payments, old numbers, new numbers, side by side.
Okay.
And importantly, it also has to show you the recoupment period, how long it'll take for the payment savings to cover all the closing costs you paid.
The break-even point.
Exactly. Whether you pay those costs up front or roll them into the loan. Now, the only time they don't strictly need that recoupment part is if your monthly P&I payment isn't actually decreasing, like in that shorter loan term scenario.
Got it. Full transparency on the numbers. Okay, let's talk costs. What fees can you actually roll into the new IRRL amount?
You can definitely include the VA funding fee, that's standard.
Yeah.
And regular closing costs.
Right.
There's also a limit on discount points. You can finance just 2 points max within the loan itself. You could pay more points in cash if you wanted, though.
Okay, 2 points financed.
Yeah. And interestingly, even if the VA doesn't require an appraisal or credit report for the IRRL, if your lender decides they want one for their own reasons, you can roll those costs in too. And there's another option for handling costs. The lender can actually give you a slightly higher interest rate to cover the closing costs internally, basically, as long as it still meets the main rule about having a lower rate and payment overall, or meets one of those exceptions we talked about.
That gives some flexibility for managing those upfront expenses. Now, what if someone's trying to refinance a VA loan that's already behind on payments? Delinquent.
Right, that's a bit different. Those IRRLs always need prior approval directly from the VA. No automatic processing there.
Always. Okay.
Always, if it's 30 days or more past due. But the upside is, if you get that approval, you can actually include the missed payments, any late charges, and even reasonable legal costs if foreclosure had started. It helps consolidate everything.
Okay, that makes sense for someone trying to get back on solid ground. Now, cash. Can you actually get any cash back in your pocket with an IRRL? Say, for renovations or something?
Generally, no. That's a really key distinction for IRLs. They're laser focused on just refinancing that existing VA loan balance plus allowable costs, not for pulling equity out or paying off, say, credit cards.
Okay.
Usually, they even round the loan amount down to the nearest dollar to avoid accidentally giving you cash. But there's one main exception. Energy efficiency improvements. You can get reimbursed up to $6,000 for those.
$6,000, okay.
Yeah, but the catch is, the work has to have been completed within 90 days before you close the IRL.
90 days prior, got it. Any other tiny cashback loopholes?
Very few, and they're really specific. Things like fixing a small math error in the calculations, or if the final payoff figure for the old loan changes slightly at the last minute, or maybe if you paid for an appraisal up front and then it gets rolled into the loan, or an escrow refund from the old loan.
Minor stuff.
Yeah, very minor. The guidance even says if it looks like it might be over $500, maybe check with the VA. The point is, it's definitely not meant as a way to intentionally tap into your equity.
Right. Keep cashback expectations very, very low for an IRRL. So how do they calculate the maximum loan amount then?
It's pretty straightforward. It's the current outstanding balance of your existing VA loan, plus those allowable fees and charges we talked about, remembering that 2 discount point limit, plus the cost of any approved energy upgrades, plus the VA funding fee.
Okay.
And like we said, if it's a delinquent loan and you have VA prior approval, you can add in those past due amounts too.
And is there a VA limit on how big the loan can be overall?
The VA itself doesn't set a maximum dollar amount for an IRRL, but the lender still needs to make sure the loan size is something they can actually sell on the secondary market. So practical limits might apply based on that.
The lender's own considerations.
Oh.
Okay. What about the veteran's entitlement? You know, the VA loan benefit they used originally. Does doing an IRRL use up more of that?
That's a super important point, and good news here. An IRRL does not impact the amount of VA loan entitlement you've already used, or what you have available for future use.
Oh, really? That's great.
Yeah, it's essentially just refinancing the existing guaranteed loan. Now, the actual guarantee amount the VA provides on the new IRRL might change slightly based on the new loan balance, because the guarantee is calculated as a percentage of the loan up to certain limits. So if the loan balance changes, the dollar amount of the guarantee might shift a bit, but your fundamental entitlement usage, the amount debited from your overall VA benefit, stays exactly the same as it was for the original loan.
Okay, so your future VA buying power isn't reduced. That's a big advantage. What about the loan term? How long can the new IRRL be?
There are limits. The maximum term for an IRRL is the original term of the loan being refinanced, plus 10 years.
Plus 10 years.
Right, but it absolutely cannot exceed 30 years and 32 days in total. So, for example, if your original VA loan was for 15 years, the longest term you could get on an IRRL would be 25 years.
Okay, prevents stretching it out too far. Makes sense. What about the legal stuff? The lien on the property, ownership?
Yeah, a couple of key things. The IRRL must be the first lien on the property. It has to be the primary mortgage.
Okay.
And it has to be on the same property that secured the original VA loan you're refinancing. You can't use it to refinance other liens or properties. And the veteran, or maybe a surviving spouse who is also on the original loan, must still own the home.
Still got to own it. Same property, first lien, got it. Now, who exactly qualifies? Does it have to be the exact same people on the new loan as the old one?
Generally, yes. The borrowers on the IRRL should be the same as the obligors on the loan being refinanced. But, life happens, divorce, death, remarriage.
Right.
The guidelines do get into the weeds on this with several case examples. It gets complicated. For instance, if a veteran gets divorced and their ex-spouse wants to keep the house and refinance with an IRL, usually the original veteran still has to be on the new loan and use their entitlement. A non-veteran can't just get an IRRL by themselves. So in situations where the borrowers change, lenders have to look closely. They might check the payment history of whoever is staying on the loan, get statements about affordability, that sort of thing. Some scenarios just aren't possible for an IRL.
Those real-life examples sound like they'd be crucial for lenders. Okay, what about living in the house? Occupancy rules. Are they the same for an IRRL as when you first buy a place with a VA loan?
This is actually a key difference and often a helpful one. For a purchase loan, you generally have to certify your intent, to occupy the property.
Right. Live there.
But for an IRRL, the requirement is different. The veteran or the spouse of an active duty service member only needs to certify that they previously occupied the property.
Previously, so you could have moved out.
Exactly. You just have to confirm you lived there at some point in the past as your primary residence. This can be really useful if you've, say, turned it into a rental property but want to refinance that original VA loan.
That is a significant difference. Okay, we touched on this, but let's nail it down. Credit check. Usually required for an IRRL or not?
Usually not. That's part of the streamlining. No credit underwriting package is typically needed. But there are those two main exceptions again. One, if the loan you're refinancing is 30 days or more delinquent.
Right.
Or two, if that new monthly PITI payment is going to increase by 20% or more. In those cases, the lender does need to do the credit underwriting.
Gotcha.
Oh, and one other situation. If you've recently filed for Chapter 13 bankruptcy, the lender might need to get the okay from the bankruptcy trustee.
Okay, so streamlined, but with important checks for riskier situations. Finally, for IRRLs, what's the typical process for getting it approved and closed? Automatic versus needing VA sign-off.
Most IRRLs can be processed and closed automatically by any VA-approved lender. They don't necessarily need that special automatic authority designation some other VA loans require.
Okay.
But, and this is the critical exception, if the loan being refinanced is 30 days or more past due, it always requires prior approval from the VA before closing.
Always needs VA approval if delinquent.
Correct. A lender can also choose to submit any IRRL for prior approval if they want to, even if it's not required. The guidelines list out the specific documents needed for each path, automatic versus prior approval. Things like your certificate of eligibility, proof you paid the funding fee, that signed statement about the rate and payment changes. For the delinquent ones needing prior approval, they'll need more, like a credit report, pay stubs, maybe an explanation for the delinquency.
That's a really thorough look at IRRLs. Okay, let's shift gears. Cash out refinancing. What's the main difference here? What problem do these solve that an IRRL doesn't?
Yeah, the main difference is really the purpose and flexibility. An IRRL is only for refinancing an existing VA loan. A VA cash out refinance is much broader. You can use it to refinance almost any type of existing mortgage or other debt that's secured by your property.
Any type, like a conventional loan.
Exactly. Conventional loan, FHA loan, even things like paying off a home equity line of credit or a second mortgage. It could be used to refinance a construction loan you took out to build a house or pay off the balance on a land contract.
Okay.
You could even use it to pay off things like a mechanic's lien from a contractor, as long as it's recorded against the property. The one thing you can't do is get a VA cash out refi if you own the property free and clear with no existing liens. There has to be something to refinance.
Got it. So it's way more versatile. Now, the source mentions type I and type 2 cash out refis. What's the difference there? Sounds important.
It is. It really comes down to whether you're taking equity out or not. A type I cash out is where the new loan amount, including the VA funding fee and allowable costs, does not exceed the amount needed to pay off the existing loan.
So just refinancing the debt, basically.
Pretty much, even if you're paying off a non-VA loan. If the new VA loan doesn't give you cash back beyond the payoffs, it's type 1. A type 2 cash out, on the other hand, is where the new loan amount is higher than the total payoff amount.
Ah, so that's where the cash out comes in.
Exactly. Type 2 allows you, the veteran, to tap into your home's equity and receives cash back at closing. And the VA doesn't restrict how you use that cash. It's yours.
Okay.
And an interesting side note, the lien being paid off doesn't necessarily have to be in the veteran's name. It could be in a spouse's name, for example, as long as the veteran is an owner of the property by the time the new loan closes.
That ability to access equity is a huge difference from IRRLs. What about the rules around lane position and ownership? Are those similar?
Yes, pretty similar there.
Oh.
The new VA cash-out loan still must be in the first lien position.
Okay.
So if you're paying off a first mortgage but keeping a second, that second lien holder would need to agree to stay in second place. That's called subordination. Need that agreement.
Right.
And, just like IRRLs, the veteran borrower must have title to the property before or at the time of closing. No minimum ownership period required, though.
Okay. And the maximum loan term for cash out, same, 30 years and change.
Very similar rule, yes. The term can't be longer than 30 years and 32 days, or the remaining economic life of the property, whichever is less.
Got it. And how much can you actually borrow with a cash out refi? What's the max loan amount based on?
For cash outs, the maximum loan amount is generally capped at 100% of the property's reasonable value.
100% LTV.
Yes. based on a VA appraisal. And you can include the cost of energy efficiency improvements, again, up to $6,000, and the VA funding fee within that 100% limit without exceeding it.
Okay.
There is one specific caveat, though, for Type I refinances. Remember, no cash out if you happen to be going from a fixed-rate loan to an ARM and you're paying more than one discount point. Then the loan-to-value is capped at 90%, not 100%.
Okay. A special LTV limit for that specific fixed-to-RM Type I scenario with higher points? Good to know. What about the VA guarantee and entitlement for cash outs? You said IRRLs don't affect entitlement. Is it different here?
Yes, it is different, and this is crucial. Unlike an IRRL, you do need to have available VA loan entitlement to get a cash-out refinance.
Okay, so this does use your entitlement.
Correct. How much guarantee you get depends on your available entitlement and the loan amount. For veterans with full entitlement, the VA typically guarantees 25% of loans over $144,000, up to the current conforming loan limit. If you've used some entitlement before, it gets calculated based on what's remaining.
Right.
But here's some potentially good news. If the loan you're refinancing with the cash out is also a VA loan on the same property, you can generally have the entitlement you used for that original VA loan restored and substituted onto the new cash out loan.
So you get it back to use again for the refi.
Usually, yes. There's a one-time restoration rule that has some complexities if you own other VA finance properties, but typically for refinancing the same property, restoration is possible. Also, if you add energy-efficient mortgage improvements, EEMs, the amount borrowed for those doesn't count against your entitlement.
Okay, so entitlement is a key factor, but restoration helps if it was a previous VA loan. Now, we know IRRLs often skip the deep financial dive. What about cash outs? Underwriting.
Completely different story here. Full credit underwriting is mandatory for all VA cash out refinances, both Type I and Type II. No exceptions.
Full underwriting always.
Always. The lender has to follow all the standard VA guidelines for analyzing your credit history, income stability, residual income, the whole 9 yards.
Okay.
And only lenders with specific VA automatic authority can approve and close these without sending them to the VA first. The underwriting decision itself must be made by a VA-approved underwriter.
So definitely a more rigorous financial check for cash outs. What about occupancy, living in the home? Same as IRLs or different?
Different again. For a cash out refinance, you must meet the standard VA occupancy requirement.
Which is?
Which means you have to certify that you intend to personally occupy the property as your primary residence soon after closing.
Okay.
This is just like when you buy a home with a VA loan. It's unlike the IRRL rule, which only requires prior occupancy.
Got it. Makes sense if you're potentially pulling out equity, the VA wants it to be your main home. What about the fees and charges? Can you roll those into a cash out loan?
Generally, yes. Standard closing costs, including the VA funding fee, can usually be included in the loan amount, as long as the total loan doesn't exceed that 100% LTV limit we talked about.
Okay.
But there's an important restriction. Specifically for Type I refinances, again, no cash out, if the refinance results in your monthly principal and interest payment actually increasing.
If the P&I goes up on a Type I?
Yes. In that specific situation, the only charges the lender can include in the loan or charge you at closing are property taxes, funds needed for your escrow account, and the VA funding fee. They can't charge other typical loan origination fees or closing costs.
Interesting limitation if the payment goes up on a Type I. Now, the document talks about a fee recoupment requirement. This sounds specific. It's for Type I, VA to VA cash outs. What's that about?
Yes, exactly. This is a key consumer protection rule just for Type I cash outs, where you're refinancing an existing VA loan with a new VA loan.
Okay, VA to VA, Type I only.
Right. The rule is any allowable fees and closing costs associated with the loan, whether you finance them or pay them out of pocket, must be recouped within 36 months.
Recouped how?
Through the reduction in your monthly principal and interest payment. Basically, the savings from the lower P&I payment have to pay back the closing costs within 3 years.
Okay, so there's a calculation.
Yep. You take the total allowable costs, excluding the funding fee, escrow amounts, and prepaid items like taxes, insurance, and divide that by how much your monthly P&I payment is going down. That number has to be 36 or less.
I see. Ensures a tangible benefit pretty quickly.
Exactly. And if your P&I payment isn't decreasing with the refinance, then remember that other rule kicks in the lender can only charge you taxes, escrow, and the funding fee, no other costs. And they specifically prohibit using temporary buy-down accounts to meet this recoupment rule.
Got it. Make sure the refi is truly beneficial in the short to medium term for those VA to VA type Is. There's also something about reducing the interest rate itself for these same loans.
Yes, another requirement specifically for VA to VA type I cash outs. If you're refinancing a fixed-rate VA loan into another fixed-rate VA loan, the new interest rate must be at least 0.5% lower than the old rate.
0.5% lower, fixed to fixed.
Right. And if you're refinancing a fixed-rate VA loan into an adjustable rate, ARM VA loan,
Fixed to R.
the initial interest rate on the new ARM must be at least 2% lower than the old fixed rate.
2% lower fixed to ARM.
Okay. And importantly, using discount points doesn't count towards meeting these required rate reductions. You can't just buy the rate down significantly with points and say you met the rule. The actual note rate needs to be lower by that amount.
Right.
And remember that other rule. If you do have more than 1 point on a fixed to ARM type I, it triggers that 90% LTV cap.
Got it. Now, what if you're refinancing an ARM into a fixed rate? Is there a rate reduction rule then?
Interestingly, no. If you're going from an ARM to a fixed-rate loan in a Type I VA to VA cash-out, there's no requirement for the new fixed rate to be lower than the current ARM rate.
Yeah.
The benefit there is considered the stability of the fixed rate itself.
Okay, that makes sense. So clear rate reduction rules for fixed to fixed and fixed ARM, but not ARM to fixed. Now, the term net tangible benefit, or NTB, comes up. You mentioned it briefly. This applies to all cash-out refinances, Type I and II.
Yes, that's correct. The VA mandates that every cash-out refinance, whether it's Type I or Type II, VA to VA, or refinancing another loan type, must provide at least one specific net tangible benefit to you, the veteran.
One benefit. What counts?
The guidelines list them out clearly. Things like eliminating monthly mortgage insurance, like PMI or MIP, getting a shorter loan term, getting a lower interest rate,
Okay.
achieving a lower loan-to-value ratio, specifically getting it to 90% or less,
Yeah.
getting a lower monthly principal and interest payment, increasing your residual income, the money left after major expenses, refinancing an interim construction loan into a permanent VA loan, or refinancing an ARM into a stable fixed-rate loan. Any one of those qualifies as an NTB.
So the lender has to demonstrate at least one of those benefits exists.
Exactly. They have to evaluate it based on your current loan's terms, even considering things like upcoming ARM adjustments, or if your current loan was modified. It ensures the refinance actually improves your financial situation in a concrete way.
That seems like a really important safeguard. Okay, what about how long you've had your current loan? Is there a waiting period, like loan seasoning, before you can do a VA cash-out refi?
Yes, there is a loan seasoning requirement, but again, it only applies if you are refinancing an existing VA-backed loan with a new VA cash-out loan. VA to VA only.
Only VA to VA.
Okay,
Doesn't apply if I'm refinancing my conventional loan with a VA cash-out.
correct. No seasoning needed then. But for VA to VA cash-outs, the lender has to check the payment history on the existing VA loan. There are two tests, Type I and Type II seasoning, depending on the type of cash-out.
Type I and Type II seasoning.
Yeah. For a Type I cash-out VA to VA, the first payment on the loan being refinanced must have been due at least 210 days before the closing date of the new loan. And you must have made at least 6 consecutive monthly payments.
210 days, 6 consecutive payments for Type 1.
Okay. For a Type II cash-out VA to VA, the rule is slightly different. The first payment on the loan being refinanced must have been made at least 210 days before the new loan's closing date, and you must have made at least 6 monthly payments total, but they don't necessarily have to be consecutive for Type II.
210 days, 6 total payments, not necessarily consecutive for Type 2.
Got it.
Seems designed to prevent really rapid-fire refinancing.
Exactly. The lender has to certify that these seasoning requirements are met.
Okay. Now, disclosures again. There's mention of loan comparison and home equity disclosures for cash outs. What are those about?
Yeah, more transparency measures. For all cash-out refinances, lenders have to give you 2 key disclosures, both initially, within 3 business days of applying, and then final versions at closing. And you have to sign acknowledging you got them.
Okay, what do they compare?
The loan comparison disclosure shows estimates upfront, then final numbers, comparing your existing loan to the proposed new VA loan. It looks at things like the loan amounts, interest rates, loan types, fixed versus ARM, remaining terms, the total estimated payments over the life of each loan, and the loan-to-value ratios.
Side-by-side comparison. Helpful. And the home equity one.
The home equity disclosure spells out how much equity you're potentially taking out of your home with the refinance. It defines home equity, basically your home's value minus all liens against it, and explains how reducing that equity now could impact a future sale or refinance. It gives an example calculation too. Again, you have to certify you received this one as well.
So really making sure the veteran understands the long-term implications of tapping into equity. Good stuff. The source also has a table comparing the different cash-out types. What are the key takeaways from that comparison?
Yeah, that table is handy. It
Yeah.
visually breaks down the main differences. It highlights things like which types allow the loan amount to exceed the payoff, only type 2, which allow equity removal, only type 2.
Right.
It also shows that the fee recoupment rule and the interest rate reduction requirements only apply to type high VA to VA refinances. And the stricter discount point limits are also just for those type I VA to VA loans.
Okay.
But it also reinforces that things like needing a net tangible benefit, getting the loan comparison disclosure, and getting the home equity disclosure, those apply across the board to all cash-out refinance types. And as we just discussed, the loan seasoning only applies to the VA to VA scenarios.
That table sounds like a great cheat sheet. Okay, last category here. Other refinancing loans. This sounds like a catch-all. What situations does this cover?
It covers a few less common specific refinancing situations that don't quite fit the IRRL or standard cash-out molds. Primarily, refinancing a loan you took out just to build your home, a construction loan. Refinancing the balance owed on an installment land sale contract, where you're essentially buying the land over time, and refinancing a loan that a veteran assumed from someone else if that assumed loan has an interest rate higher than current market rates.
Ah, okay. Specific cases. Are there any different rules for the maximum loan amount or the VA guarantee for these other types?
Yes, slightly different rules here. For these other refis, the maximum loan amount is the lesser of two things. Either the property's VA appraised value plus the funding fee, or the total outstanding balance on the debt being refinanced plus allowable closing costs, discount points, and the funding fee.
The lesser of those two. Okay.
You can also include energy efficiency improvements in these loans too. And for the VA guarantee on these specific other types, it's capped at a maximum of $36,000.
A $36,000 cap on the guarantee for those.
Good to know. Okay, wow, we've covered a lot of ground. So as we kind of wrap up this deep dive on VA refinancing, can you maybe give us that quick flyover again, the main distinctions between IRRLs and cash outs? Absolutely. Let's boil it down. The core purpose. IRRLs are strictly for refinancing an existing VA loan, usually aiming for a lower rate payment. Very streamlined. Cash outs are much broader, refinancing over any secured debt, and can provide cash back.
Purpose. Streamline VA versus refinance, anything get cash. Got it.
Requirements. IRRLs generally need a lower interest rate and usually a lower payment, with exceptions. Cash outs don't have those specific rate payment reduction mandates across the board, though NTB rules apply.
Rate payment rules. IRRL's stricter, cash out's more flexible, but need NTB. Okay.
Cashback. IRRLs basically no cashback allowed except EMs.
Yeah.
Cash outs, especially type 2, are designed to allow access to equity.
Cash back. No for IRRLs, yes for cash out type 2. Simple enough.
Underwriting appraisal. IRRLs often skip the appraisal and credit underwriting, unless delinquent or big payment jump. Cash outs always require a full appraisal and full credit underwriting.
Underwriting. Minimal for IRRLs, usually. Full for cash outs, always. Perfect. That's a fantastic summary. Really lays out the core differences clearly. So for you, the listener, we really hope this deep dive has demystified the world of VA refinancing options a bit.
Yeah, the goal was to give you a solid foundation.
Exactly. It really comes down to thinking about your own financial goals, your current situation. Does the simplicity of an IRRL make sense, or do you need the flexibility, maybe the equity access of a cash out?
And remember, these are complex products. Don't hesitate to dig deeper or talk to a qualified lender or advisor.
Absolutely. So maybe the final thought to leave you with is, considering your home financing situation, what's the next logical step for you? Is it learning more, talking to someone, just mulling over whether refinancing makes sense right now? Something to think about. Thanks for diving deep with us.